Hi there, it's Brad Flynn again, looking at some tips for your business. In particular today we're going to be focusing on something called your cash flow projection. I like to call it your sleeping tablet because it's the thing that's going to help you sleep at night. In our first video we talked about financial statements and how they relate to the three domains of time. So we have the three domains of time, of course, being the past, the present and the future. Profit and loss was about the past. Things that had happened in the past that we didn't have any control over. It was our scorecard for the end of the game. The balance sheet, which is in the next video, is about where we sit right now with our business, how our numbers are right at this very minute. And then the third portion of time is the future, which is where the cash flow projection comes in. Now, a cash flow projection is your best guess at how you think the cash will flow in your business in the coming future. I always recommend having a cash flow projection of at least 3 months or 12 weeks. That way, if we're going to have a cash crunch in 3 months' time, we can start to do something about it now. Too many business owners that I know and have worked with in the past were just flying by the seat of their pants. Putting in place a cash flow projection and knowing when we're likely to get dips so that we can start to do something to avoid those dips and crashes up front makes a huge difference. And as I said, helps you sleep at night. Now, on the coaching program, I'm going to give you the templates for all this sort of thing that you can just fill out your own numbers for. My intention today is to teach you what the principles are so that you can go away and implement that straight into your business and complete your own cash flow projection so that you know exactly how much cash you're going to have in the bank at any time in the future, or at least a pretty good idea of it. So, fundamentally, cash flow is about real-time accounting, I guess you could say. It's your best guess on when the money is going to flow in your business. Basically, it's the sales or whatever money will come into your business for a particular time frame minus any expenses, and expenses can be everything from your rent to your cost of goods to wages, anything where money will go out of your business. Tax is one that you need to include in there as well, particularly for your GST and pay-as-you-go, so as you don't get stung with this nasty surprise with your tax bill. So sales minus whatever those expenses are gives you the remainder, the difference between the two. Then what we do is take that amount and add it to your current bank balance to give us an idea of how much money you're likely to have in your bank account. So let's have a look at a specific example. Hopefully you can see this clear enough on the screen. So in this particular example, down here, we've got all the different items of expenses and sales. So the first item is our sales. Then from there below, we're going to have an allotment for any money that goes out in your business. Sales is about any money that comes into your business. So cost of goods sold, rent, phones, wages. So they're just a snapshot of the ones that I've taken here. In your business, you're going to have to flesh out every little thing that's going to go out in your business. Now, you're going to spend a fair bit of time getting this set up to begin with, but once you've got it in place, it's just going to be a matter of either weekly or monthly, depending on how your cash flow is, checking in, updating it, and making sure we've got that target bank balance there in your bank at all times in the future. Now, then we've got the total, which is basically your sales minus whatever your expenses are for that period, and then we're going to add that to your bank balance. So let's put some numbers in. Now, on the top here I've got week 1, week 2, week 3, week 4. So we're going to look at how we best estimate the money is going to flow in your business. Because at the end of the day, you have a bit of a choice when you pay bills and if you need to hold it off or negotiate with suppliers. Also, from getting the money in, getting your invoicing done on time, following up with people who are a little bit slow paying is critical for cash flow. You may have heard cash flow is king, and nothing could be truer in your business. No cash, no business. The cash is the blood in your business. So we've got to make sure that it keeps flowing, because if it ever dries up, business dies. Alright, so here we go. Week 1. In this example here, we've had $1,000, or we think in this first week we're going to have $1,000 worth of sales come in. Maybe we've been told by certain debtors to us that they're going to pay us this week. Maybe it's based on what our average sales have been in the past. Either way, we estimate that we're going to have $1,000 come into our bank account this week. Now, our phone bill's due this week, and so are the wages. So phone bill 200, wages 500. So for that 1,000 that comes in, 700 will go out, which leaves us with 300. Now at the end of last week, we had $1,000 sitting in the bank. So now at the end of this week, we're going to have $1,000 plus 300 gives us 1,300. Now don't get too bogged down in the timing specifics. We'll work this out for your business when we get to it. So now we look at the second week from now. In this week, we're estimating we're going to have a great sales week. So we're anticipating $3,000 of cash is going to come into our business from people who owe us money. But we've got to pay our cost of goods this week. We've got a bill from our supplier. So that's got to be fixed up. And we've also got to pay our wages again this week. So wages, continuous. That's why I want you to put these figures out 12 weeks in advance. So 3,000 in, minus 800, minus 500 gives us $1,700 left over at the end of the week. Added to the $1,300 we had at the start of the week gives us a new bank balance of 3,000. Week 3, another great week in sales. $500 in rent this week. So with things like rent, when you know when they're going to come out on a particular day of the month, put them in for those 3 months in advance. If you really want to, do it for 12 months and then you know exactly what's going on. Wages again, $500. 500 plus 500 is 1,000 going out, 3,000 coming in, 2,000 left over, and we had 3,000 in the bank at the start of the week. So now we're going to have 3,000 plus 2,000, $5,000 left in our bank account. Now week 4, this one's interesting. Sales are down a bit. We think 2,000 is going to come in that week. However, we've got a big supplier bill, the cost of goods. That's going to take a fair whack out of our cash flow this week. Plus, we've still got wages. So 2,000 minus the 3,000 we've got to pay out, minus the 500 means this week we actually go backwards. So our money in was less than our money out, leaving us with a deficit. However, we had $5,000 in our bank account last week. So what that means for us is that we'll have 5,000 minus 1,500 to give us $3,500 at the close of business this week. So as you can see, this number down the bottom, we must make sure stays positive. If at any stage in the future it goes red, we need to take action further upstream or have an alternative cash source available to prop it up. But first and foremost, we want to sort it out as we can with the cash flow that we've got. Boost sales, reduce costs, whatever we have to do. So hopefully that's given you a good overview of how cash flow works in your business and how we're going to start to predict it going forward to give us our sleeping pill. I'm Brad Flynn.
No, that ain't working. That's the way you do